Sean, how are you thinking about historically the way munis have reacted to not 25 but 50 basis point moves, maybe 1, 2, 3 of them from the Federal Reserve?
Yeah, it's been a while since we've been in this situation, Taylor. I think the market is well set up for what will happen at 2 o'clock tomorrow. It's 2:30 when Chair Powell will lay out both the path and the trajectory that the market will be facing, not only in the near term, but also in the June and July meetings to see if 50 basis points are ahead of us there as well.
How do munis react to that, to the tightening, and then, of course, the commentary around the balance sheet as you think about some of the relative value in your world?
Yeah, again, I think the market has done a good job pricing in what it foresees in the near future. We've had a rather tumultuous beginning to the year, not only in munis, but just in fixed income in general with the repricing of the market. Traditionally, munis hold in rather well when rates rise. That wasn't the case early in this year, but we know why. Munis have gone from price for perfection to having a little bit more room in them given the repricing. So we're looking for munis to hold in well post the Fed news tomorrow.
Have you in your career seen this level of bond volatility? We talk about equity vol all the time. The gyrations we've had in yields, the relentless climb higher. How has that sort of impacted some of the supply and the demand dynamics as well?
Yeah, I have not seen something like this in my career, but often where there's volatility, there's opportunity. We talked about patience coming into 2022, and now the market has reset in yield and in price. Supply-demand dynamics have certainly changed from what we saw in 20 and 21, where demand significantly outpaced supply. Now we're seeing supply match demand, and at periods of time, demand needing to step up. So I think we're in a different environment today, but again, one where a little bit of stability in the market will go a long way for munis in the near term.
Where is the best opportunity then at this moment?
Currently, the front end and intermediate of munis is looking quite attractive. By going out just 5 years on the curve, one's able to pick up 80% of the entire yield curve, and you only take on a portion of duration. It's been a long time since we've been able to say that. 1 year ago, going out 5 years on the curve, you only picked up 23% of the entire curve. So an opportunity in the front end and in the belly of the curve where there's good liquidity.
Does high yield credit is a good place to pick up yield, or is that too much FOMO?
Oh, I don't think it's too much FOMO. Obviously, high yield adds in a couple more components, such as longer duration, and obviously you're adding it a bit more credit. But if your view is that we've reached some stability in the interest rate market and that rates have room to rally back, then high yield munis will offer the duration and the performance that you're looking for.